Funny that you mentioned I went to school a lot for economics. I actually knew I wanted to be an economist in high school because my parents wanted me to go to STEM, and I did not want to be a doctor or an engineer. So I was like, okay, what is the closest thing to STEM that I can find that I'll still like? And fortunately or unfortunately, I actually really liked my high school economics class. Everyone I talked to either hated it or loved their economics class. So hopefully I will be, either converting you or kind of re-emphasizing why economics is great. But actually, on that note, I spoke to some economics students late last week, and they have their basic questions that they always ask people who work in the industry. First one, of course, what brought you into economics? What made you decide to be an economist? And so I thought back to those high school days when I chose to take economics. It was in the middle of the global financial crisis, and I was, this high school kid. I had never heard the word economy. I didn't know what it was, but suddenly it was all over the newspapers. Everyone was talking about it. All the uncles, aunts, they all had, reasons for why the economy is crashing. And I was like, what is the economy? No one has ever told me this. Why is it so bad, and why am I hearing about it all of a sudden? And it feels kind of like that right now, too, with tariffs. Because we didn't really have to talk about tariffs that much, and now suddenly they're everywhere. Trade wars, even inflation. We didn't have to think about it or talk about it until like 2020, 2021. Then it was everywhere. And that's kind of what economics is. It's supposed to be working in the background while the rest of you go off and do your thing. But then everyone starts paying attention when things don't go as they should. And so this graph that we have here is a quick glimpse of how things have changed and how drastically they've changed in the last few months. So since we've had this new US administration, and they are still new, they've only been in power for the last few months, they've of course done a number of things across a number of policy platforms, but on the trade front, they're essentially upending the global trade dynamic as we have established it for the last 50 or so years. So this graph here is just the average tariff rate imposed from the United States just over time. And you can see that we estimate that the tariff rate is actually at the highest that it's been in about a century. But really, since the end of the Great Depression, tariffs have been coming down, and we've been going slowly towards this more free trade type of world. What does that mean? So tariffs or any other trade barriers, they just mean if you are buying something from outside of the country, so say if you want to get yourself a little treat, you want to get a t-shirt or something online, you're likely buying it from somewhere outside of Canada, or for the United States, a US consumer buying it made somewhere from outside of the US, they're paying a tax on it. It's not the only trade barrier that there is, but essentially it is one of the main ones, and it's one of the US administration's most popular ones. What the US administration is trying to do right now is they're trying to bring a lot of that manufacturing that went outsourced over the last few decades back to the United States. That is one of their goals. Whether or not that works is another point, because as you can see, this is quite a meaningful shift in the tariff rate. And so if you are a business, a multinational corporation like most are, if you are a business that is working or has been working in this world where, you might get a t-shirt made in China or in Vietnam, you might get, your lumber from Canada, you might get this or that from another country, you hadn't had to think about it for decades, and now suddenly you do. It takes a lot to switch over, to get new suppliers, to reorganize your entire supply chain. So that is what we're dealing with on a big scale. As of right now, and again, all of this comes alongside a number of policy announcements that get announced on social media. They get announced either through leaks from the White House. They often get delayed, very, very often get delayed or recanted or exempted. So there's a lot of moving pieces even with this broad idea of, okay, the US government wants to impose more tariffs, right? So as of right now, and again, this could change very quickly. This changes literally by the minute. It could change by the time I finish the sentence. But as of right now, what the US government is doing is they have imposed a 10% tariff on almost all of their trading partners, except 145% tariff on China. And they've got a number of other sector-specific tariffs that we are dealing with here in Canada. So in Canada, we've got a 25% tariff on everything that's going to the United States except energy, potash, and some critical minerals that are getting taxed at a lower rate at 10%. If it is not compliant with the USMCA, we've also got 25% tariffs on steel and aluminum and 25% tariffs on all autos that are going into the US that are not made in the US. In a couple of weeks, we're also getting 25% tariffs on the portion of all auto parts that are not made in the US. That is a big deal because it is a very, very complicated situation that we have right now in the auto manufacturing industry. So for decades, again, for the last 50 or so years, when people didn't have to think about tariffs, the auto manufacturing industry and a lot of other industries, but autos in particular, they built a cross-border supply chain so that every car, every auto part crosses the border a number of times, crosses the Canada-US border, the US-Mexico border, what have you, countless times before it is completed as a final auto part. And then think about all the thousands of parts that go into a final car. So right now, there's no way to even figure out exactly how much of a car is built in the US because there's no mechanism for tracking that because it's been so complicated because, again, this process has been going on for a number of decades at this point. So again, Canada dealing with these auto tariffs, dealing with these steel and aluminum tariffs, dealing with this 25% tariffs, also dealing with the number of other tariff threats. So we know that the attention of the U.S. government shifts quite quickly. There have been a number of threats of potential tariffs on semiconductors, potential tariffs on lumber, which is another huge sector for Canada. All of that just means that there is a lot of uncertainty out there. We've kind of heard that. I think we hear it a lot in the housing market as well. People don't know what to do when there's a lot of uncertainty. So uncertainty itself is a bad thing for the economy. Now, two things to keep in mind as I kind of move on from what exactly tariffs are. One thing, I think one of the major points to remember when we're talking about tariffs is that they do not have the same impact no matter who you are, where you are, especially depending on what sector you work in. So I mentioned very briefly about autos. Autos, again, if parts are going across the border countless times and each time they come into the United States, they're getting tariffed, that can add up very quickly, right? So we've already seen a number of layoff announcement, temporary closures at a number of plants here in Southern Ontario. But then on the flip side, we've also got a sector like Canadian energy. So Canadian crude oil in particular, a lot of that oil, in fact, most of that oil goes to the US, specifically to a lot of refineries in the US. And those Midwest refineries, most of them are located in the in the Midwest, they have very few alternatives. So domestically, they don't have the same capabilities to produce the same type of oil for the same price. If they're looking at other countries like Venezuela, for example, there may be other reasons, like politically, you may not want to buy from Venezuela. Or even, again, that cost of transporting something from Venezuela versus transporting it from Canada. So options for buyers of Canadian crude oil, for example, are very limited. And so that puts Canadian crude oil producers at a much better advantage, right? Because they can pass along those extra tariff costs to their consumers. And that's why the US government has also announced those lower tariff rates, that 10% tariff versus that 25% over most other things, for things like Canadian crude oil, for things like critical minerals, and for things like potash. That said, we still have an impact, and the impact is going to be negative. So again, these forecasts change very, very quickly. They changed on Friday after we got a few more announcements. We got announcements that electronics were going to be exempt from tariffs Friday afternoon. So these numbers, again, changing, but I think the big picture to remember is that it's bad. It's bad for economic growth. Tariffs are bad, especially in Canada, where, again, we've built this economy over the last, half century, really, if not longer, of, trading with our neighbor next door, which is the largest economy in the world. And so we have a lot of sectors that are going to be impacted here. It's not just the autos. It's not just energy. It's really a broad-based impact. And so we are expecting Canada to be looking at a recession this year. We do have growth pegged at 0.7% this year, and then we have to build in exactly how long we expect these tariffs to last, exactly which tariffs are going to be in our forecast. So for now, we are expecting a recovery next year because we are expecting that these tariffs will be lifted by the middle of next year, because that corresponds to when the new free trade agreement is scheduled to be renegotiated. Whether or not that happens, whether or not the tariffs actually get lifted the middle of next year, whether they get lifted 4 years from now, or whether they get lifted this afternoon. It's all kind of up in the air, but again, we have to put something in our base case scenario. So we do have a recovery, but it's going to be slow and steady as soon as these tariffs are lifted. But again, as of right now, we are expecting a mild recession here in Canada for this year. Second graph here, a lot of what you guys care about, what's going on with interest rates. So the Bank of Canada is dealing with two kind of forces here that are moving in opposite directions. So one, tariff, tax on imported goods. So a tax means the price is going to go up regardless, whether it goes up temporarily, whether it goes up, on an ongoing basis. Either way, inflation is going up. Then we have the economic impact, right? So that weight on the economy, if that is large enough, which we do believe it's going to be, it could outweigh that upside risk on inflation. And so again, we are expecting a recession. That is a shock on the economy. And so on net, we do think this downside risk for Bank of Canada policy rates are going to outweigh those upside risks to inflation. And so on net, we do expect that the Bank of Canada is going to cut further. So right now we have overnight policy rates at 2.75%. We do think there's going to be 3 more rate cuts this year, and that would bring the overnight rate to 2%. Again, a lot of this could change. The timing could change. It has changed in our forecast a number of times, but that is what we are expecting for now. And lastly, I'll talk about this in a bit more detail, but the Canadian dollar is also expected to weaken a bit further, at least until, or stay weak, I should say, at least until those tariffs are lifted. And so in this graph, we have the Canadian dollar in Canadian dollar terms. So I'll just put in a caveat. When the line goes up, that means the loonie is weakening. So again, we do expect more weakening until we get to normal, whatever the new normal is, starting next year, hopefully starting next year. So I did mention a lot of this impact will depend on exactly what sector you work in, but because of the way that our country is built, it also depends on what province you live in. So this is a very quick look at the vulnerability, or one way to measure the vulnerability of each province to U.S. trade. And that's literally just the share of U.S. trade as a share of each province's economy. And you can see Alberta has the highest share of exports going to the United States as a share of its own economy, but you can also see that almost all of that is energy. So I did mention energy is a bit of a special case. It has the lower tariff. It has the ability to pass along most of that economic hit to the U.S. consumer. And so if you take out energy, so you just look at the blue portion of the bars, so take off the green, blue is non-energy exports, so everything else. And you can see that manufacturing really stands out here, especially auto manufacturing. And because Ontario is the hub for auto manufacturing, Ontario is really going to get hit the hardest, at least by our estimations. And again, auto is one of those sector-based tariffs that the U.S. administration has already put in the spotlight for quite a while now. So that puts Ontario in a bit of a tough spot when we're looking ahead to our forecast for the full year, to our forecast for next year. We actually, if you've seen any of my presentations or any other economic presentations over the last few days, you may notice, if you're really eagle-eyed, we did have the Ontario economy contracting this year. We've revised that up a little bit just because, again, it looks like Canada's avoiding a lot of attention from the U.S. government right now. So hopefully we're kind of at the worst of things, at least from Ontario's perspective. It's not going to get much worse, hopefully. But again, that can change very quickly. It can change as soon as the president presses tweet or post or Truth Social, something. But again, so Ontario is expected, regardless whether it contracts or only expands 0.1%. On the ground, that doesn't really change much. For the main picture, Ontario is expected to lag all provinces in economic growth. But you can see at the top there, we have Alberta benefiting, again, quite significantly by the fact that they're relatively more insulated by these tariffs than the rest of the country is. Now, for the country as a whole, we actually are in a decent position coming into this trade war, and I do want to point out and kind of highlight these sources of momentum. And that's because the Canadian economy is driven a lot by Canadian consumers. It's a consumption-based economy, and consumers are some of the most interest rate sensitive in the world. And so we saw kind of the downsides of that in 2022, 2023. You can see that blue line was kind of flat around that time, and that's because, of course, interest rates were rising so aggressively. that consumers just had to pull back. They couldn't afford to buy a lot of goods and services, right? But then we also saw the flip side of that in 2024 as rates started to fall. In the second half of the year, we actually started to see some momentum building, not just in consumer spending, but also in things like production. We were just creating more economic momentum as a whole was starting to broaden. So we are coming into this in a much better position than we could have been and in a decently strong position. But then again, meaningful tariffs from our largest trading partner, and also the downside risks of lower U.S. economic growth from all the tariffs that they're imposing on every other country. Those are going to be the main headwinds for Canada in this year, next year, potentially further. And just a quick illustration of what that rate sensitivity looks like. So Canadian household debt as a share of its household income I should say still is amongst the highest compared to other peer countries, definitely a lot higher than what we see in the United States. It was at a record high just a couple of years ago. As rates start falling, people demand less. So demand less mortgages mostly is what the debt usually is. And so you're seeing some improvement in that debt burden, but on the other side, that debt service ratio, so the cost of servicing that debt, those interest payments, those mortgage payments, those still have a little bit of upward pressure, and then they again started falling as interest rates started to fall. Now, what does that mean for other areas of the economy? For things like the job market. So it's important to remember, the job market affects all of us. We all have jobs. We all know people with jobs looking for jobs. It is important to remember when people are talking about the job market that it is a backwards-looking indicator. So what does that mean? That means that if you have something like an inflation shock or a trade war, something shocking the economy, it's going to take some time for that to flow through to business investment decisions, to consumer spending decisions, and then to the demand that businesses see on an everyday basis. If you think of your mom and pop shop or even those big businesses, it takes some time for those businesses to make decisions on whether they should be hiring more people, whether they should be laying off people. Making those HR decisions really takes a little bit more time. And so a lot of times you're seeing data from, say, February that's really reflecting economic conditions from months beforehand. So despite that, the unemployment rate, the job market in general have deteriorated quite a bit. They were historically tight coming out of the pandemic, which essentially just means if you had a job or if you were looking for a job, it was historically relatively easy to find one. If you think about, people talking about quiet quitting, people talking about, I'm only going to work if I can work remotely, those kinds of talk, that happens when workers have more leverage, right? So historically, it was quite a good time to be a worker coming out of that pandemic era. But then, again, rates start rising. Not just that, but the population started booming. It was rising above 3% year over year, which is the highest growth rate that we have seen since the baby boom. And so all of these people are coming into the country, can't find jobs, right? We just can't crank out jobs fast enough to keep up with the number of people coming into the country. And so all of that meant that, again, job market loosening, building slack, just fancy terms of saying it's getting harder and harder to be a worker. Fewer job openings available, harder to get hired. And again, if you look past that vertical line to our forecast, we do think that it's going to get a little bit worse before it does get better because, again, we are expecting a recession. So you can see how all of this recession type of conversation, what does that mean? It does mean, yes, things might get a little bit worse, but a lot of that is based on our assumptions for what's going on in the trade war, which again can change very, very quickly. So it's very hard to be an economist right now, very hard to have these forecasts. Because again, it can change very quickly. People at the office are constantly talking about whether or not this line should go up or down or go up higher, go up lower. So another important thing to think about, again, as we're just talking about the hard numbers right now, not the forecast, just the hard numbers, what we have seen so far, which again, backwards looking, but what we have seen so far is that the job market has deteriorated much more in Ontario and specifically the GTA than it has over the rest of the country. So you can see that the unemployment rates for Ontario and Toronto are much higher than they are nationally. So we're looking at about 2 percentage points higher in Toronto than for the national average. That regional differentiation is really playing out, I think, in the housing market more than potentially anywhere else, at least for now. So this is one way to show kind of how the housing market has come out of the pandemic and to where it is now. So in the last 3 years, from the peak in February 2022 to now, the latest data we have nationally until tomorrow is February 2025. So in the 3 years nationally, we know, of course, there was a bit of a cooling. The market was at its peak. It's now no longer at its peak in the last 3 years. But it really, again, depends on where you live. So we're seeing a lot of these relatively more affordable areas, like places like Newfoundland and Labrador, like Moncton, like Calgary, like Prince Edward Island. A lot of those relatively cheaper areas are still seeing quite a bit of demand. But on the other side, it's Southern Ontario, especially those suburbs, especially those exurbs of Toronto, still dealing with quite a bit of price decline because, again, prices had risen so quickly, especially if you think back to 2022 when people are talking about, working from home, don't need to go to the office, don't need to live in Toronto anymore. Where can we move? We can move to Kitchener-Waterloo, we can move to London. And so we're seeing some of that still, the consequences of that, I should say, still playing out in the sense that now those prices are so high, they're no longer affordable. So again, either people are moving back to Toronto, but it's really more people are trying to go elsewhere in the country. Another way to look at that, market balance. So Toronto, still a buyer's market. So again, that's pretty rare. I'm a millennial, and I remember, again, thinking back to high school when I started paying attention to the economy, everyone was like, the housing market sucks, you're never going to be able to afford a house, like, da-da-da-da-da, the bubble has to burst. Thankfully, we didn't see a bubble bursting, and I should knock on wood here, but thank you. It's really been slow and steady, pretty good, pretty decent buyer conditions in Toronto and in a lot of Southern Ontario because, again, that balance is kind of tilting towards buyers in a way that we haven't really seen or seen much more rarely in the last few decades. Again, it also depends on where you live, right? So nationally, the market is in balance. Again, pretty rare to see on a national basis for the Canadian housing market to be in balance. But again, a lot of those relatively cheaper areas, especially in Alberta, we know that it is more affordable than it is here, but also, again, their economic outlook is a lot stronger right now, so potentially easier to get a job, things like that. So people are still demanding houses there. It's still very much a seller's market. In Alberta, even in Quebec, Montreal, Quebec City, a lot of those smaller cities in the province of Quebec, some of the tightest markets in the country right now. And just zooming in a little bit to Toronto, sales activity does remain quite low. It is still below average, decently below average. Again, not in correction territory, but it is still subdued. Again, that affordability picture remains a challenge, but we do think that there are still some pent-up buyers still waiting for rates to keep falling. Some of that demographic, boost is still there. There's still a lot of millennials out there who are looking to potentially upsize, start a family, things like that. So there is some demand on the sidelines. There is some opportunity here, but again, it's going to take some time. And one way to look at that affordability picture is really what we think is constraining a lot of buyers right now, especially in Southern Ontario. So we can see that affordability, there's a lot of ways to measure affordability. This is one of them. It's just literally the share of your mortgage payment to your household income. Affordability peaked, or unaffordability peaked, I should say, at over 50%. So that means mortgage payments were more than half of a household's income at its worst. And so that's pretty much the worst we've seen in about a generation since the late 80s. And it has come down a little bit, not just because rates are starting to come down, but also because incomes were keeping up. So again, remember, the labor market was historically tight. Incomes were still keeping up. Income growth was still higher than average. And so again, that took some pressure off of household budgets and took some pressure off of those affordability calculations. And we do think it's going to improve a little bit going forward because, again, rates are falling. That's going to help. But that income side of the ledger is likely kind of losing some steam here as, again, we start looking at a potential recession. So you can see how, again, what goes on with tariffs is going to impact every single thing in the economy, especially and including the housing market, and especially in Ontario. So just looking ahead, again, we have this kind of slow and steady forecast for the housing market. It's pretty rare to see that, especially on a national basis and especially in Toronto. But essentially, we are expecting sales to remain kind of subdued, but to recover slow and steady, slow and steady, slow and steady is kind of the name of the game here. Prices to recover slow and steadily, slowly and steadily. Because, again, yes, we have this downside risk from that economic hit from potential tariffs. We do have a potential recovery penciled in for next year. We also have the lower rates. We also have that demographic demand. We also have incomes eventually catching up, again, as those tariffs are lifted. Final kind of point that we used to talk about a lot in this country until about last year. Again, the immigration story, the population story was one of the biggest stories in this country if you think back to the good old days of 2024. So again, the population in this country, it's hard to overstate the impact that it had. It grew the highest that we have seen since the baby boom. That is a huge shock to the economy, huge shock to things like the labor market, but also the housing market. And so we had this, a huge number of people coming in, but most of the people coming in from outside of the country were non-permanent residents. Out of those non-permanent residents, most of them, overwhelmingly most of them, were international students. So I'm gonna set that aside for a second and talk about the other thing that was kind of overshadowed by all of this immigration stuff, was the movement of people within the country. So if you were already in the country, we again saw a lot of people moving from those more expensive provinces, especially Ontario, especially BC, and moving to those less expensive, more affordable regions, especially Alberta, and to some degree also the Atlantic provinces. So this is where we see this trend continuing, is the people that are already here, even though that international immigration flow has kind of stopped. As of the end of 2024, we're still seeing that shift in interprovincial movement still continuing. That is what we're seeing in the housing market right now. That's kind of reflecting those trends. But on that international angle, again, most of those people, not permanent residents. So they're not necessarily looking to buy a place or even a small place. They're looking to rent. And so that's why we've seen such a strong correlation over the last couple of years between population growth, again, mostly non-permanent residents, and rental prices. We've already seen in the news countless headlines, especially in Toronto, that rental prices are coming off their peak. They're finally starting to slow, and they're in fact declining in a lot of areas. And that is, again, because the federal government announced these new immigration targets specifically for international students starting at the last school, or I guess the start of this school year, so last fall. It's already starting to have an impact. We're in fact expecting, based on the targets that they announced, for immigration to hit a slight negative this year and next year. And so again, we do expect additional, downside pressure on these rental prices until we start to see a normalization starting in 2027 and onwards with, I guess, more normal immigration patterns. Last couple of topics to talk about for the economy. The Canadian dollar, struggling real bad. For those of us, at least before all this tariff stuff happened, that liked crossing the border to get your Trader Joe's fix or what have you, it was tough. And historically, we have seen this almost one-for-one relationship between the Canadian dollar, the value of the Canadian dollar, and oil prices. That broke off during the pandemic when we saw, this huge, once-in-a-lifetime source of uncertainty. The whole world is shutting down. What does that mean for markets? What does that mean for banks? What does that mean for everybody? Mostly people started shifting towards the U.S. dollar in favor of the U.S. dollar at the cost of other currencies like the Canadian dollar. And so we saw this divergence between oil prices and the Canadian dollar. A lot of that has continued. Some of that is due to divergence in interest rates. Some of that is due now to the trade war. But I think one important key takeaway here is that the fact that the loonie is lower, it might hurt those of us trying to still buy things from outside the country, but it actually does help Canadian exporters because they are, of course, the main targets of these tariffs from the U.S., but they're also the ones still trying to go out there, sell their goods to international buyers. And so if you can say something is, hey, $50 Canadian, and the Canadian dollar isn't doing so well, then that looks a lot cheaper. So that can absorb some of that tariff impact from Canadian consumers. So it's not necessarily a bad thing, again, to see a lower Canadian dollar. Now, summing this all up, if we try to kind of think about all of the things, why does this matter to interest rates? It all comes down to inflation. Again, we didn't really have to think about inflation for a long time because it was pretty low and stable, around 2%. until we got to the pandemic, until we got to all this pent-up demand as lockdowns started getting lifted, people demanding a lot more goods, inflation starts spiking to a generational high. It was around 8% versus the Bank of Canada is targeting 2%. We started to see quite a decent textbook slowdown, I would say, as the bank started raising interest rates. And that started, again, rate-sensitive households started pulling back on their spending, pulling back on demand, pulling back on inflation, ultimately. And so we did actually have about half of 2024 where inflation was back at target or even under target. And so things were looking pretty good for the Bank of Canada. That's why they started cutting. Latest data we have is a potential, again, spike a little bit in inflation, but there's a lot going on there. We've got the sales tax holiday, which is, of course, ended as of mid-February. We've got the consumer carbon tax, which is now zero. That's going to help. We've got tariffs, which are going to lift inflation. We've got gas prices declining, oil prices more broadly declining. There's a lot going on there, and just a quick example of what exactly the Bank of Canada looks at when they start talking about inflation. There's hundreds of components of what actually goes into how to calculate the consumer price index, which is the measure of inflation that we use here in Canada. These are not all the components by any means, but these are just an example or some examples of there are, in any given month, there are things that are way higher than 2%. There are things that are way lower than 2%. And so on average, they're trying to see exactly where underlying inflation is. So if you look on the deflationary side, so that's things pushing the consumer price inflation lower, you've got things like books, childcare, toys. These were a lot of things that were exempt from sales tax, right, until February. This data is as of February. And so you're seeing a lot of that impact still in the data. On the other side, mortgage interest costs, you see rents, you see property taxes. A lot of that real estate cost is still a lot more elevated than you would want with inflation at 2%. So that is still on the upside. Yes, it is definitely coming down. It has come way down, especially since the peak, but it is still there. It is still a bit stronger than the Bank of Canada would like to see. So again, there's a million ways to slice and dice exactly what inflation looks like beyond just the headline numbers. This is just one example of some components that the Bank of Canada is looking at. But just to show you exactly the kind of movements that go on in every single month, they have to account for all of that and try to look past all of those temporary moves to keep inflation at 2% on a sustainable basis. And what does that look like right now? So again, we're starting to see some movements domestically with sales tax holiday coming off, consumer carbon price coming off, with the tariffs coming on. So again, a lot of moving parts here. Again, we do think that the bank is going to cut 3 more times. We do think that they're going to be a little bit more cautious. So they had been cutting at subsequent meetings. And in fact, in the last 2 meetings, they had said, I'm not going to put words in the Bank of Canada's mouth, but essentially what they had said was inflation is actually kind of, picking up a little bit. But if it wasn't for this tariff threat on the economy, we might actually consider pausing. And in fact, they had considered pausing at the last meeting, but they decided to cut rates anyway because, again, that huge, meaningful risk on economic growth from these tariffs. So moving forward, they've got another meeting this week. We actually think they're going to pause, and we think they're going to be a little bit more cautious now that Canada has so far avoided the worst of a deterioration in the trade war, now that inflation, again, is picking up a little bit, now that there's all these factors in inflation and in the economic outlook more broadly. We think they're going to be a little bit more cautious, and that's why we're only expecting 3 more cuts this year. Finally, getting back to all this uncertainty out there, I think the way that I like to think about all of this uncertainty is not just to focus on the numbers or necessarily to focus on the lines. Like I said, those change very quickly. But what I do like to focus on is where the risks lie, and that is really important when you're trying to look ahead, when you're trying to plan for the future. Okay, there's always going to be upside risks, there's always going to be downside risks. Where do the net risks lie, and how can we manage those? So this is a quick look at exactly how we're looking at the risks for specific areas of the economy. So you can see for growth, if the arrow's going in the red direction, that's bad. If the arrow's going into green, that's a good thing. So for growth, we're looking at a pretty sizable downside risk to the outlook for GDP growth more broadly. But then if you look at something like rates on net, we have the 3 rate cuts penciled in, but on net, where do the risks lie? They lie towards even lower rates. And so that's why we're going a little bit towards the green side. And again, for real estate, we have the slow and steady growth. Things are a little bit in the red right now, but again, we're expecting if there is a risk to that housing market outlook, that things are actually going to be looking better thanks to that risk of more rate cuts. So main point to keep in mind before I start opening it up to questions, there is a lot of uncertainty out there, yes. There are also a lot of opportunities. There is also a decent amount of momentum in the Canadian economy. A lot of this does come down to exactly how the trade war unfolds in the coming months, in the coming years. And unfortunately, that's not something we can control, or anyone really outside of President Trump can control. So what we can focus on is the things we can control. What we can focus on is the things happening within our country. And so that's when we start looking at, how's the household feeling? How's, economic activity going? That's when you start thinking about things like diversifying, things like that you may have seen in the news. And importantly, the fact that the Canadian consumer, again, pretty decent shape before all this started happening. So globally speaking, yes, there are these tariff risks. There are a number of risks with the US as well. If they slow down, we're likely going to slow down as well. But things are looking decently in Canada. Hopefully, this all gets resolved very quickly, and we can start focusing on kind of the rest of the economy. But for right now, I think I'll just leave it at that and open it up to any questions.